Hello, my name is Christopher Bergen and I am the President and Publisher of Tax Analysts. As part of Tax Analysts' ongoing mission to educate the public on tax policy developments, we've produced a video highlighting the recently issued final regulations on the net investment income tax, which was enacted as Section 1411 of the Internal Revenue Code. Among our guest speakers today are David Kirk and Adrienne Mikolashek, the principal draftpersons of the Regs. Dave and Adrienne are both attorneys with Branch 2 of the IRS Office of Chief Counsel, Pass-Throughs, and Special Industries. We'd like to express our gratitude to their boss, Kurt Wilson, for making them available today. The 3.8% tax on net investment income was enacted in 2010 as part of the Affordable Care Act. It is a truly separate, complex, and technical tax regime on investment income. In December of last year, the service issued more than 40 pages of proposed regs intended to help clarify the application of this tax. Since that time, there have been many articles and programs devoted to analyzing and understanding this new tax and the proposed regs. One such program was presented by the Texas Federal Tax Institute last June, followed by another more in-depth program in November. The November event was co-sponsored by the Texas Society of CPAs and Tax Analysts. Adrienne, along with two of today's other speakers, Jeanne Sullivan of KPMG and Richard Dees of McDermott, Will, and Emery, were joined by Amy Sutton of Deloitte Tax in a detailed discussion on the topic. If you are interested in the materials or the video from that program, you may contact the Tax Fed at texfedtax.org. Special thanks to Kevin Thomason, President of Tax Fed, for arranging the attendance of today's speakers. Today's video will focus on the differences between the proposed and final regs. Those final regs, along with a new round of proposed regulations, were released just a few days ago, right before Thanksgiving. We at Tax Analysts will disseminate this video analysis free of charge as part of our ongoing commitment to advancing the national understanding of our tax laws and administration. Thank you for watching.
Good morning. We're very fortunate today to have the two principal drafters of the final regulations that were issued very recently, November 26th, I believe, right before Thanksgiving, on Section 1411. And we'll just start to try to frame the issues by asking Adrienne if she'll explain the statute and why we have these long regs.
Well, come on, the statute's only 2 pages. It took us a little bit to get the details out. The Section 1411 is the 3.8% tax on net investment income, essentially unearned income. Seems like a fairly simple statute. You know, there are provisions that talk about how to get the income together. It's your interest, rents, royalties, dividends, and then other income, and then the third kind of category of income are the net gains from the disposition of property that's not used in a trade or business. So we're looking for gains or losses from passive activities, gains or losses from trading in financial instruments and commodities. You know, that's very general categories of what the kind of income is that is being pulled into it. It doesn't include unemployment compensation, workers' comp, things that don't yield a tax result, the sale of a home, the 121 issues. Once you've gathered all your income, the statute then provides for certain deductions, properly allocable. So those that would otherwise be deductible under Chapter 1. So you've got your income, your deductions, we net it all out. There's some special rules which are set forth that we'll talk about in a little bit for the sale of interests in partnerships and S corporations, where you've been actively engaged in those. So if I've been participating in the activity, the business, that all of that gain shouldn't be included in my net investment income. So there's some special rules to figure out how much of it should be. It also, the statute says qualified retirement income is not included in net investment income. So a lot of people breathe a sigh of relief at that one. But working capital is. So businesses get a little nervous. That means my interest in my mutual fund, or the checking account that I've got set aside for assets to work with in terms of the business. That is, unfortunately, from your perspective, going to be included in the categories of income. And then the 3.8% tax, there are thresholds. For individuals, married, it's $250. For single, it's $200. And then married filing separately, it's $125, if I recall correctly. Tax is also imposed on trust and estates. Trust and estates, they're taxed at the highest tax bracket, or their threshold is at the highest tax bracket, which I knew for last year was 11,550, 950, and this year
This
it's
year.
12. For 2013. For
11,000,
2014,
950, and it's 12 something.
12 something for next
I
year.
don't remember.
And I will turn it back over.
Yeah, I guess the idea is that this 3.8% is like a flat income tax on the lesser of your net investment income or the amount by which your modified adjusted gross income exceeds these thresholds that Adrienne explained. So the key here is the definition of net investment income. And proposed, when is the statute effective?
The statute is effective as of January 1st of this year, so we're all living within these rules, which is why the final regulations to come out by the end of the year were so important.
Yeah, and the proposed regulations did come out last year in December, which was just before the statute became effective. Now they've been finalized. Lots of changes, but the basic structure of the regulations remains, I believe 10 or 11 sections. So I wondered if we could talk about, the first thing is, what you mentioned some of the items of income that are excluded. People are very interested in what income is excluded. There is something of a list in the final regs, but it's not a comprehensive list, as I recall. So one of the things that are income from services, is that ever included?
W-2 income?
In net investment income?
No.
No, it is included in your threshold, obviously.
Right.
But it is not ever net investment income. So income from services, just getting the mindset, this is passive income, income from trading, and investment income, not income from services.
Now, I mean, what is unique about this, and for regular taxpayers and preparers and tax professionals, what 1411 is a dual tax-based system, where you have the net investment income, which is 1411C, and a good portion of the regulations are trying to determine and give calculation examples on how net investment income is determined. But you also have this other tax base, where it is the amount of your modified adjusted gross income in excess of your threshold amounts. Mm-hmm. And so you have two tax bases that you need to manage. And so even though your W-2s are not included, the year-end bonus that one might get will cause one base to go up, and that might actually have sort of a marginal rate of tax on it that might indirectly pick up 3.8%. Mm-hmm. Because you have investment income from other sources, and so it's how the two bases compare to each other is very important, and that's often overlooked when everyone is focusing so much on the definition of what net investment income is.
That's right. It's almost like a parallel tax system.
Oh, it absolutely is a parallel.
And that's
universe.
why we have how many pages of regs?
Well, we're getting there. See, I mean, when this whole thing started, it was, it took about 2 years to develop the proposed. 2012 proposed came out right around Thanksgiving. That came out at about 159 pages, and there were a lot of complexity associated with it, because for two basic reasons. One is that 1411 is not included in Chapter 1 of the code. Okay, Chapter 1 of the code is what we consider normal regular income tax. That's regular income tax and AMT. But we have Chapter 2, which is self-employment tax. That's been separate. And now we have a new Chapter 2A. And so when you reading your code sections, when you crawl up with your favorite one at night, and you're reading it, you now have to read it to say whether it says for purposes of this chapter, because if you're reading that and that's in Chapter 1, your ears need to poke up, because what is that going to do for 1411 purposes? The other piece that makes it very complicated is they used the cross-reference to 469 to identify passive income-generating activities. And 469 was developed in 1986 to identify loss generators. So what we basically have is we have two tectonic plates crashing together. One, we have 25 years worth of history on 469 that's been focusing on trying to identify loss generators strip out things that are artificial income generators to get to the core of what it was meant to do in 1986. And then we come along almost 30 years later and use that same definition to identify income producers. And so they crash together and they produce very, very strange offspring. And that's really the two big pieces, theoretical pieces and structural pieces that we need to understand that makes a 2-page statute incredibly complicated.
And so, I'm sorry.
I just wanted to say that even though the 1411 regs are not simple, you were able to resist the temptation to develop a whole
Yes.
completely new system. It's helpful to tie back to Chapter 1 in the way that you did in the regulations.
I mean, we acknowledge that, we'll definitely come out and acknowledge that Rome was not built in a night. This entire parallel universe is not going to be built by itself in 307 pages. We acknowledge that there are things that we did not cover. There are going to be things during this next filing season and the next year that people are going to uncover. They're going to sit around in April, or in most cases now October, trying to prepare the tax returns. They're going to get, what is this income? Client's going to come in with the most bizarre circumstance. And how do you apply it? And we acknowledge in the preamble to the companion proposed reg that came out in addition to the final that we want to know what else is out there. We're not doing this and closing the doors. We are very much open to expanding or working on this as part of the general guidance priority list that we publish every year to take on new questions and new concerns. But the main sort of the underlying theoretical principle that Richard brought up was that we tried to adopt Chapter 1 to the extent we could. That's been around for 100 years. And it's pretty close to working. And the idea was that we are not meant to recreate the wheel. But if something is broken in Chapter 1, broken might be a little flippant, but broken meaning it's unresolved, or it has strange results, or certain regs are not updated because statutes were changed and whatnot in there. We're bringing that in, the good, the bad, and the ugly, and that when it's fixed, and if it gets fixed in Chapter 1, then it will be complementary and it'll be naturally fixed in 1411 land. And so a lot of issues, what 1411 has done, and we'll talk about issues later, that it exposes a lot of these bizarre circumstances that currently exist in Chapter 1 that might have gone sort of very much under the radar ever since.
Right, and that's an excellent segue because 469 is the second bucket. I think of net investment income as 3 buckets. The first is defined portfolio type income. The second is income from a passive activity or income from trading. So let's look at the 469, which is the passive activity. And by the way, I do want to say these regulations are complicated, but they did try to explain fundamental principles so that we will have something to apply to the unexpected circumstance, which is, in my view, precisely the way regs should be written, rather than trying to cover every little jot and tittle. And I know that Adrienne worked on the 469 piece. Section 469 provides that taxpayers, individuals, estates, and trusts, as well as others, but since 1411 only covers individuals, estates, and trusts, that's all we're really interested in here today, can't take net losses, are unable to use net losses from their passive activities. A passive activity is defined as a trade or business activity. There's one problem in Chapter 1, in which the taxpayer does not materially participate in most rentals, regardless of whether it's a trade or business. So perhaps Adrienne can give us a little bit of insight into how they worked with the problems of 469, which I think David explained quite well. It's focused on losses to make them work for 1411, which is trying to pick up income.
Well, a lot of the comments that we received were trying to figure out, in 469 it'll recharacterize certain things, or it'll work together where you've grouped certain items. How did that then play into the 1411 world? The trade or business issue was huge, particularly in the rental activities. How did we handle that? And if you kind of walk through each of those,
Yes.
starting, for instance, with the rental real estate
Yeah, let's
issue.
start with rental. This is a very good result.
What we did here was basically try to find a way to allow certain taxpayers who qualify as real estate professionals for 469 purposes to also be deemed a trade or business for their rental activity if they meet certain thresholds. The thought was that these folks, they're actively engaged in that activity, and therefore we could essentially give them kind of that trade or business character. So if you're able to meet the 469 requirements of 469C7, and you spend 500 hours in your rental real estate activity can be either one or grouped depending on how you've chosen to do your business. If you've met that threshold, then for 1411 purposes, we're willing to consider it a trade or business. So for instance, if you're getting rent from that rental activity, you've met those thresholds, it wouldn't be included in that from the
rents.
statute, it's the one little I category. So it wouldn't be considered rent for 1411 purposes.
Because
Yeah.
it's from an ordinary course of a trade or
trade or
business in which the owner participates.
It's that
non-passive.
magical parenthetical language in the one little I. What is it? C1 cap A, one little I.
I don't know.
It's the otherwise derived in the ordinary course of a trade or business that everyone just appreciated so much that the statute offered us absolutely no clarity on. So it gives you that trade or business for that piece. It also, if you participated within, it's the 5 and 10 rule, if you participated within the last 5 to 10 years at that 500 threshold, it gives that to you as well. It also provides not just the rental income, but it also provides for the disposition. It was important, we felt that in terms of the parallel concept, that you should not only get the annual income, but the gains and losses, which would otherwise have been put in the net investment income, that similarly be excluded as well. So that took care of the rental real estate issue
For real estate professionals.
for real estate professionals.
We also, I got a lot of calls from people who had set up structures for state law purposes. It's a self-rental, the self-rental. And what was happening is 1411 was kind of crashing into structures that were set up for totally non-tax purposes, and it was creating passive rental income that would be picked up by 1411 in what we thought, as commentators, was not appropriate, and the regs address that.
And the regs, similarly exclude self-rental income to the extent that the income matches the rental, and is also excluded from the one little I category, is not going to be treated as rent.
Right.
Again, along the same lines, having heard the commentators, the thought was that it should be excluded. And a similar rule also applies
For grouping.
I was thinking self-charge interest.
Self-charge, I was going to move to that, but grouping is also rental.
Grouping in terms of the characterization. What Jeanne's referring to is there was a lot of question, if we're going to group, what are we going to do if I'm going to group my active trader business with my rental activities? So this is the 469-4 requirements. Whether or not I can or can't, you've got to answer that question for Chapter 1 purposes. But if you have chosen to group those activities, what does that do to my rental activity? And that was the famous however sentence that David was asked about on numerous occasions when the proposed regulations came out.
It scared people.
And I think that the reaction scared Dave.
It's now a proper name.
It's the however
The however
sentence.
sentence.
So to address the however sentence, we basically have taken the position that, look, if you've grouped your rental activity with an active trader business and you're active in the collective group now, then again, we will treat that rental activity as part of the trader business, and the rental income will not be included in your 1411 income. So the however sentence is now moved.
The rents were big because a lot of people have rental income is generally passive, which would be in 1411. So these are exceptions for real estate professionals, people who are active and own real estate in connection with an active trader business.
And there's a pending case, the Frank Aragona trust case, where the IRS is taking the position in tax court that trusts cannot be real estate professionals. They got left at the door.
Remember, this statute applies to trusts and estates as well as individuals. So it's that's an issue within 469. What is the rule? You want to?
The however sentence that basically said in the preamble that even if you do group for 469 purposes, that does not cause in essence a for-profit, a Section 212 activity to become a trade or business. And people started scratching their head and because that was new, I guess. But there's a provision in 469-1TD1 that basically says that what happens in 469 stays in 469.
Which is generally a good idea.
It doesn't affect the greater universe. And so when we came up with these provisions where we are deeming a trade or business to occur for real estate professionals, for self-charged rent, self-charged interest, and grouping, we have that same language, or very substantially similar language, in 1411-1 that says whatever is going on in 1411, you do not get spillover effect back into Chapter 1. So we don't have a backflow of, 1411 has deemed this to be a trade or business for this narrow purpose. It is now a trade or business for all purposes. That was not the intent. It was meant to be self-contained for this specific policy purpose.
Right, and it's a very helpful rule. It makes the statute more easily administrable, and I think self-charged interest that Adrienne mentioned is really the key. It helps people not have to restructure just to avoid 1411, so that the economics of the situation will be taken into account. Maybe you can explain.
Well, that's exactly what we were hearing, was
Yeah.
people were looking to, whether it was self-charge interest or self-rentals, I mean, they were looking to figure out how to reorganize what were otherwise very functional businesses just because of the tax. With the self-charge interest, essentially those are usually the transactions between a partner in a partnership, for an example, loans money to the partnership, and that interest that's coming back out again is going to be deemed to be passive.
Under these
rules.
Yeah. Rather than the portfolio.
Rather than portfolio. So in this particular instance, we've essentially adopted the 469 rule to allow it to move forward and keep the same Chapter 1 effect, essentially.
Right. So what we've done, let's see, you have some other 469 related. I mean, there were a lot of problems in the coordination of 469 and 1411. I don't know if we have to.
They were
go
all
into them.
469 problems, nothing to do with 14.
Right,
That's
but these regs do attempt to address them, and the final regs. I don't know if we probably don't have time to go into all of it, but just so people know, they put in rules for former passive activities. They put in rules for the recharacterization rules for certain income that's recharacterized under 469 as non-passive. Because remember, we're trying to avoid passive income generators under 469. So there are rules in the final regs. If you feel like you need to describe these, feel free. I just want people to know. And so the 469G, and I think that's it. So there's a lot of work that's been done to try to coordinate 469 with the 1411 tax. There's also a very big change that these regs made in properly allocable deductions. Remember, Adrienne mentioned that your deductions will reduce your net investment income. Everybody wants that net to be lower rather than higher, 0 being the best answer. So the properly allocable deductions were an issue in the proposed regs for a number of people. One, for traders. People who are traders, as defined in the Chapter 1, will have net investment income whether they materially participate in their activity or not. Trading income from trading is not subject to SICA, and it is subject to net investment income tax. Do you want to explain the problem, or?
Well, I mean, what was happening is that there was basically a glitch in the proposed regs where there was the trading gains was associated with Category 2, but the losses from basically the similar transactions were being dropped into Category 3. And what Category 3 said was net gain meant net gain cannot go below 0, and you are not allowed to then repurpose any excess losses as a properly allocable deduction to be used against interest income, or in the case of traders, even the net gain piece, or the gross gain, I guess you'd call it, that was being assigned to Category 2.
So economically, all mixed.
So it was just, yeah, and it was a glitch. It was one went one place, one went the other. It was not consolidated, and so that's why they were
concern.
That's why they were proposed. And
Except they apply. Remember, 1411 applied. 2013.
Well, yeah, except for the regs.
And estimated taxes.
Except the regs didn't apply
No, I
until
know.
the following year.
Yeah.
So we did have a grace period.
Yes.
But, so how this was basically resolved was that traders and passive activities, trades or businesses, those are the two Section 1411 trades or businesses that we're trying to capture. The rules now are basically parallel for them. No traders do not get special rules for anything. Passive don't really get special mechanical rules unless absolutely necessary in order to keep the tectonic plates from destroying things. And so it basically says that all gain transactions, gain and loss transactions, think basically 1001 events, are category 3. Okay, and we have gains and losses are all there for everybody. Okay, so if you are an investor, they're there. If you are in a trader business of trading, they're in there. If you are a passive activity that has either capital losses or 1231 losses, those are ordinary and capital. They're both in section in category 3. But what we say is that category 3 still cannot go below 0. Okay, net gain means net gain. But what we basically say in the properly allocable deduction section, which is section 1411-4F4, says that to the extent a loss that is allowed for Chapter 1 exceeds the amount of gains that are in Category 3, then it soaks up that excess loss and is used as a properly allocable deduction to offset other income, gross income from the other categories. So that's interest, dividends, rents, royalties, annuities, passive activities. So if you have a giant ordinary loss because you are a trader that made a 475 election, or that you have a large loss, 1231 loss from a passive activity, you wipe out all of your category 3, and then the excess comes down and will offset your net investment income from other categories. And it does produce some very strange results. We got a lot of comments on people not wanting that were asking, why can't I get my $3,000 capital loss? Right? And that was a big one.
Yeah, it was a tiny little nit that was very irritating.
For traders, it's potentially a much larger loss.
Well, it's a much larger loss, but if you're not an electing trader, it's still only the $3,000 capital loss that you're allowed because everything else is suspended and carried forward. But we have some examples in -4F4 that say, it's just not the 3,000 because there are other circumstances, other very strange anomalies that result when we allow these losses to spill over, especially when the basket of gains and losses, are not the same basket that we're using for Chapter 1. Okay? Because remember, we exclude from the Category 3 basket gains and losses from property used in non-Section 1411 trades or businesses. So that would be your 1231 gains and losses from equipment used in your accounting firm or your law firm or your restaurant business. Those are pulled out, but they still go into the mathematics in Chapter 1. And so when you start stripping things out from the gains and losses, you get some very strange answers. And so when we're developing the forms and instructions right now, line 5 it starts with what your Schedule D is and what your 4797, and it backs out things. And it's going to show, we have worksheets that are trying to be developed to show how this works, and we might get some very strange answers.
But theoretically,
it
was a good
pure,
answer.
Right, it's pure and it works.
Because what was happening is people's net losses were trapped and they were never usable. So you don't have carry forwards for net investment income losses. So if you don't use them, you lose them.
True.
So this gives you
With
the opportunity to use
exception,
them.
You're allowed the one exception to the
yes.
fact that we generally had the rule that NII can never go below 0. That was in the proposed regs. We took that statement out of the final. So NII can go below 0. The same way taxable income can go below zero. If you ever had a tax return that showed negative taxable income for a human, it's possible. But that doesn't necessarily mean that that human creates a net operating loss. And so we have the same premise, that you can have negative net investment income for the year. It just means you're not paying 1411 tax that year. But it doesn't mean that that negative amount gets to be used as a deduction the following year. It needs to hook its wagon to one thing, and that's a 172 NOL.
Right.
And if it can hook its wagon to that, we're allowing it. And that was one of the big changes from
Big
the
change, yes.
from the
the
proposed.
proposed, right.
We said that it was too complicated, and
It is complicated.
it is. Because you're basically doing with and without calculations. Do your NOL with it, do your NOL with only 1411 items, and then figure out what portion of your NOL. But since each NOL is created on an individual year-by-year basis, you're going to have vintages. Okay, the 2013 vintage might have 40% baked in NII losses. The next year might have 10%. But as the 13-year vintage is being burned off, used, it's gonna spit off that percentage of NII deduction, and so you're gonna have to follow what the vintage is.
So,
It is complicated.
And there are good
Doable,
examples.
but complicated.
One of the things, I used to actually work at the IRS, and one of the things I always thought would be helpful in regs was a lot of examples. And the NOL example is quite extensive. The capital loss carry forward is probably worse.
Oh,
but
yes,
anyway.
thank you.
Better.
That's
Better.
mine.
Let's say better.
When the rule itself
But they're good examples. They're
is
helpful.
2 sentences long for capital loss carry forwards, but the example is 6 pages to show the exact import of how that works over a 7-year period. That's the only way one could really see how it works. And that's where the rubber meets the road. If this doesn't mathematically work and mechanically work, the best theoretical rule is going to fall apart.
So this is actually to be commended, because these were difficult regs, and there is a lot of good information in them. One thing that comments were adopted for NOLs and carry forwards, and improving the properly allocable deductions so that we get excess losses, which we do now, as long as they're allowed in Chapter 1. But one of the comments was, what you have done to the sale of partnership interests and S corporation in the proposed regs, we cannot use. And so that was something I think Adrienne was going to discuss, how the government responded to the very critical comments about the proposed regs.
Well, what we've been talking to up until now are the final regulations. Also on the same day, we dropped a notice of proposed rulemaking, so we've now issued proposed rules under the same statute. -7 for the regulation was withdrawn from the original 2012 proposed and essentially reissued in that document. And we did. We listened to the commentators, went back to the drawing board, and tried again. This time, we've essentially created 2 systems. We are looking at property that we're calling 1411 property. So that property within the entity that, if sold, would give rise to Section 1411 income. And what we're doing is we're piggybacking for the primary calculation, we'll refer to it as. We're piggybacking on the 469 rules. Under 469-2TE3, I believe it is, there are rules for what happens when you sell a partnership interest or an S corporation. So it's something that for Chapter 1 purposes you're doing anyway. So we basically are stealing some of the information that you're already calculating to try to figure out what your gain or loss is. And we have, you're looking at the lesser of. So it's the lesser of how much did you sell your partnership interest for, or how much is the built-in gain or loss. So, and we've got to walk through both. So if you have a loss, there's a separate calculation, and then if you have a gain, there's a separate calculation. But hearing the and it's also activity by activity. That was another thing we got a lot of criticism on, because the prior proposed regulations, it was asset by asset. And that was very burdensome. How was the partner or S Corp shareholder going to get that information? It was going to require valuation studies. So this, because it uses the 469 concept, it looks at activities, your investment activity, your portfolio activity, your trade or business activity. So we rely heavily on rules that are already in place. But we also wanted to simplify it further. Again, hearing the commentators, we had made an attempt at a safe harbor. And as Dave indicated earlier, we want to hear from the public, as we did the first time, with details. We tried for a safe harbor based on what a taxpayer would have in their hands, their K-1s, their information statements. It's not going to be available for everybody. There are certain people who we basically said, yeah, we don't think you belong here. But the two primary safe harbor qualifications are, based on a fractional component of your historical income. We think you have about 5% of the assets within the entity are what we'll call Section 1411 property, and it's a defined term in the reg. And your sale proceeds are no more than $5 million. Then the second qualification was it's a $250,000 threshold, that your gross proceeds are no more than $250,000.
Your gains.
Your gain rather was no more than $250,000. And if you've met those thresholds, then based on the information that you've got within your historical income, you're going to use a fraction again, approximate what we think the percentage of the gain is that should go into the 1411 bucket. One of the things that's been pointed out in comments, and we will correct it in the technical, is there is a typographical mathematical error in the one example for the 5% simplified method, where the loss was subtracted in the 5% test and should have been added. But as I said, we'll catch that.
The words say that.
Well, but what's important is when you're doing the 5% threshold test, you're treating your losses as though they were positive. You're adding
That's
them.
right. Mm-hmm.
But when you're doing the actual calculation, how much to put in, the losses are netted, so they are subtracted.
Okay.
And to the point people find that that's confusing, I guess we need to hear about that so we can change the terminology in order to make it clearer.
Everyone's happy with that change except the appraisers.
Oh, that's okay. We've also shortened the information that needs to be provided.
Yeah, which is a big problem with partnerships, and S corps, of course, aren't even used to doing a lot of this. I don't want to shortchange trusts. We have a couple more things to say, but maybe Richard would like to talk about the trusts and estates.
There's not a lot to say about those because some of the decisions were deferred. But the preamble discussing why certain obscure trusts like the Alaska Settlement Trust or the Funeral Needs Trust are in or out of the net investment income, I thought was an excellent job, praiseworthy, and very thoughtful. And it's an example, I think, of the way the regs are, final regulations and preamble are written. In the trust area, there are extensive changes in charitable remainder trusts, which I think were unusually taxpayers wanted more complexity rather than less.
We came out in the proposed reg with a what I call a binary method, and because the 664 rules and the regulations are worried about, CRTs are tax exempt vehicles, except they retain items, they hold them, they retain their character, and they pay them out. And when they pay them out, they pay it out based on the worst income first, or the WIFO regime for lack of anything better to call it, based on the highest rates. And since there are so many different rates within Chapter 1, there's all these very extensive ordering rules. But we only have one rate, and it's either 0 or it's 3.8. And so our general idea was to just say that it was the worst comes out first, 3.8, that however much you get goes out first. And the other big thing we did was grandfather everything that was inside a CRT, accumulated income, before basically January 1, 2013. So you don't have to go back for very old CRTs into the first Bush administration to figure out what things were way back then. But people they felt more comfortable with the 664 regime, which is categories, classes, and so what they got was an accordion. There were approximately 6 or 7 different categories and classes, and now they doubled because there was pre and post. There was NII tagged items and there was non-NII tagged items, so it expanded. And so it is incredibly more complicated. The 1/2 page rule is now, when we add in the proposed rules on trying to address CFCs and PFICs, is now 12 pages. But it was one of those things, you wanted it, and fine, we gave it to you.
The big issues on trusts and estates were basically problems in Chapter 1, as we've been talking about. One is the way capital gain enters or not enters distributable net income. That's an obscure topic, but the basic problem is that the 39.6% rate begins to apply when trust income gets to $11,950. That is very high tax, and it really is almost irrelevant to say, well, you would then add on 3.8% more. The real problem is the 39.6%. So can't really solve that problem either at the IRS. That's a congressional issue. And the other issue is the 469 regs, as we said before, don't address material participation, how to figure out if a trust is active in a business. And that's created a lot of uncertainty. It didn't matter very much, as we've said, when it was only about losses, but it matters significantly now. And you've asked for comments on that subject.
The one thing, there are several areas there are actually 2 areas in the final regs about trusts. And in several areas in the proposed, we've asked for very specific comments. And we did the actual language for the request for comments to be a little different or a little more precise, because we want you, for lack of a better word, to suffer as we suffer in trying to figure out how this mechanically will work. Because it's easy to say, yes, you can do something or just do it, make the end result that. But working through the mechanics of getting the end result is really, really tough. And so, the commentators need to sit back and say, well, if I want this answer, it sounds easy, but is it worth doing 16 pages of rules to get that one bottom line answer? And they need to make their own sort of personal judgment call. And if they've suffered through it, they can then say, this is the appropriate answer given the benefits and burdens.
One of the problems is in the material participation area, there was a 2013 ruling, actually Tech Advice, that took a very extreme view, in my opinion, of material participation. And so a lot
of a trust,
yes. And a lot of my clients are concerned that that is the law, and they're not persuaded that just because you're going to look at the question again of material participation, that means you're going to come up with an answer that's less extreme. And when I suggest to them that the regulations suggest that the IRS being very reasonable about all this, I sort of lose credibility with my clients to say that. So unfortunately.
Well, it depends on how high our credibility was to start with. But no, I mean, this is just one of the examples of, if something is broken in Chapter 1 or is unresolved, it would have to be a separate project, because this never would have seen the light of day.
And the issue is critical for a lot of family businesses that hold their interests in businesses, S corps and partnerships.
That's a very common
trusts.
situation, is to use trust for business succession reasons.
So, especially with S corps. And so the question is whether this income is subject to 1411 or not. And that's decided by the question of whether the trust materially participates, and there are no rules.
And this is the last, this is not the last you're going to see of us. Well, maybe us, depending on how this is received back at the office. But 1411, it's going to have offspring, and material participation is going to be one. And we're just going to have to, within a community, both on the IRS side, practitioner side, taxpayer side, knowing that we are going into uncharted territory here. And this year is going to, it's going to be some growing pains for everyone concerned. For 2013, these regs are not effective.
Yeah, I wanted to ask that. What are the effective dates?
The proposed regs are not effective, either proposed regs. And there's a
Just the
provision
statute.
that says that you can rely on the final regs and the proposed regs, any combination thereof, for 2013. And that will give you some comfort, but you can do it sort of a la carte. You can pick from, want to use the 2012 proposed regs because for some reason you like the -7 rule in that better for you, or you could use the proposed regs for something else, so the 2013 proposed for something else over here, then that's okay. We needed to be able to be comfortable and get people comfortable that this is, that the IRS is not going to start enforcing these things or come out of the gate heavy-handed. We are doing our best to make sure that we can all get through this together, because at the end of the day, we're all in this boat together.
That is actually a good segue to the end, which I think we have reached. We are working together, and I know we will at the ABA. I work with the ABA and AICPA, and all of the various bar organizations will be providing comments, I'm quite sure, especially since we saw that our comments were actually acted upon in the past, and that in these final regs, in the new proposed. So it's very helpful to work together. And we appreciate all the work that this was, because these are quite extensive regulations. And they did try to make them work well, I think. We didn't get everything we wanted, though, and unfortunately I don't have time to complain. But
Oh, perfect timing then.